Great. Well, thank you very much. Welcome, everyone, to this panel on impact measurement. So we've got a great panel session lined up for you here. We were expecting to have another panelist. She may still arrive. We're hoping. She's probably got snarled up at Westminster somewhere. But just as a quick intro from me, I'm Sophie Edwards, a news reporter here with Devex in London. And so we've been hearing a lot about the need to crowd in more private investment, to create the right kind of tools for that, or a pipeline. But let's talk a little bit about impact, because what is the point of crowding in all this investment if it's not actually going to lead to real development impact on the ground for the people that really matter? So we're here today to discuss some questions around that. How do we define what is impact? How do we measure it? And who should define it? And who should measure it? These are just some of the questions that we're going to tackle today. So I'm joined on the panel by Clara Barbie from the Impact Management Project, Elizabeth Boggs-Davidson from UNDP, and Gerbrand Haverkamp, did I pronounce that right? Okay, from the World Benchmarking Alliance. We were hoping to have Karima Ola from Leapfrog Investments, so if she turns up, that's great. But if not, we're going to leave some time for questions at the end, and obviously it'd be great to get an investor's perspective, so we'll be trying to pick on you for some insights when we get to that point. But so, Clara, let's start with you. It'd be great to hear about what you're working on in the area and just maybe set the scene for us. What kind of impact measurement principles do we have and where are the gaps?
Yeah, of course. So the first observation I would make, and I know this is really obvious, but it's actually the impetus behind the Impact Management Project, is the observation that context matters when you are talking about impact. And so if you look back at the genesis of the Impact Management Project, which started 3 years ago, which was a kind of by the industry, for the industry effort to come together from all different disciplines. Development finance, Nick just spoke about measurement in the DFI community, but also impact investors, mainstream ESG investors, big companies, multinationals, small social enterprises, social science. We brought everyone together. And it took a few years, but what we were really looking at is when people say context matters for measurement, do we actually agree on the dimensions of performance that tell you about context? And the answer was, actually, there was widespread agreement. And it was pretty easy to, if you gave it the time, bottom out what that was. And so that's why you'll often see the Impact Management Project is what, who, how much, contribution, and risk. They're the 5 dimensions of performance which give you the context about what is happening on the ground. That matters, obviously, for measurement, because that tells you the kind of data that you would expect companies to be collecting, managing with, and disclosing to their investors. Now, what's been really interesting over the last year, to come to your question of where is the landscape today, is that we've had the privilege at the Impact Management Project of facilitating a network of standard-setting organizations, global organizations, who in one way or another are providing standards of practice and performance and benchmarking for companies and investors. And the observation that I wanted to share, because it's so nice to have Elizabeth and Gerbrand on the panel, who represent the leadership of 2 of those organizations, is that when people say measurement, I think a lot of people think of just sort of one bucket. Now, if for a moment, for those of you who have a financial background or an accounting background, or just know a bit about that world, I just want you to think about what we do in finance. And we do a lot of different things. We have standards of practice in finance around the governance and processes that you would expect to be in place in a company or a fund. We have standards of performance measurement, which we call accounting, and they're consistent across companies of all shapes and sizes. And then we have analytical tools to compare performance, to benchmark. And we never confuse those things. We never say that accounting is the same as ROI, return on investment analysis, nor as valuation. And what I guess I'm going to say to you as a message today is, let's try and be as precise as we can when it comes to impact, to measuring social and environmental. There are many different things in the box. It's not just one thing. And so, as we've been doing this work over the last year, we've had to pass that out separately and be very clear with the organizations we're working with, which of you is working on which part of the system. And Elizabeth will speak to practices, to the standards of process that you would expect to be in place if you were trying to contribute to the SDGs. We've then been working with, and I've seen some colleagues in the room, the OECD is playing a really important leadership role on the framework for measurement. And that's being worked on in collaboration with GRI, with SASB, and with the Social Value International group. So there you're seeing people say, well, actually, even within the measurement of performance, the framework is different to the metrics, and we need both. And then obviously Gin is working on metrics, as are GRI and SASB. The final piece is then the so what of metrics. If you've actually measured performance, it's the benchmarking. And that's where her brand and the World Benchmarking Alliance are playing a really important role, because it's a fascinating question right now as to when we benchmark performance, when you're a company making decisions about which impact to have, or you're an investor making decisions about which company to invest in, you are intuitively benchmarking in your mind. And what's happened is that recently people have started to say, we need to make that explicit because there's lots of judgment there that people need to know that you're making. And so benchmarking has become a really important area. And I think what Herbrand's doing is saying, look, those benchmarks need to be open so that people can see exactly the trade-offs you've made when analyzing a company or an investment. Some people are still doing it in a proprietary way, and I think that's a fascinating question. I will leave it to Herbrand to address, but I really want to leave you with the image of, let's separate out measurement of practices, measurements of performance, and then measurements that benchmark.
Brilliant. Well, Herbrand, that brings us straight to you very nicely then. And actually, I'd just like to add one other question to that on the benchmarking. Is it fair to compare all companies and contexts? Like, should they be held to exactly the same standards? Maybe if you're working in an FCS country, or you're a company based in a low-income country, should you be really held to the same standard as Unilever?
Right. So the Dutch way to pronounce my name is Gerbrand, but since no one can do that, I pronounce anything vaguely. No, that's fine. Just so that we have got sort of Gerbrand, and you made a sort of nice German twitch to it, which is nice. So my name is Gerbrand. I'm the director of the World Benchmark Alliance. And just to give you, before I get to your question, is it fair and how do we do it? So to understand where we are coming from, so the World Benchmark Alliance is a non-for-profit. That is a legal term, so it doesn't matter, but it means that what we do, that's much more important, is for the public domain. So we are essentially focused on creating benchmarks that can assess how companies are performing on the SDGs. Which companies? Those are we're focusing on the 2,000 keystone companies, and that's a term we've borrowed from science. And a little story. If you've ever heard the story about the wolves in the Yellowstone Park. So they were reintroduced in that park, and because of their reintroduction, they changed the entire ecosystem, right? They started to hunt for deer, deer started to behave differently. Because of that, the shrubs started to regenerate, trees started to regenerate, and even erosion stopped. And so the entire flow of the rivers changed because of those wolves. I'm doing a very fast version of a 4-minute clip on YouTube, which is worth your time. The point here is that these wolves are what we call from biology keystone species. Right? Keystone is a term that comes from somewhere else, but we're not going to go into that. So in biology, they talk about these species that have a disproportional influence on their system. And in a similar way, we are trying to identify what are the companies in today's economy that have a similar disproportional influence on their industry and therefore on the system that they influence. When we say system, we talk about the things that need to change in order for the SDGs to be achieved. So we need a transformation of our food system, our energy system, digital inclusion, social inclusion. We need to focus on circularity and urbanization, and then there's, of course, the financial system. Within all of those systems, there are industries that shape those systems, right? So if we talk about finance, it's the bank, it's asset managers, it's asset owners. If we talk about food, it's food and beverage, retailers, input suppliers. And what we're doing within each of those industries, we are looking for those keystone companies. What are the companies that are critical in shaping those industries? We think globally there are about 2,000. And we'll publish that list in January for everyone to scrutinize it and to give us feedback on it. Of course, there are many, many more companies. I spoke to the International Chamber of Commerce last week in the UN General Assembly, and they have 45 million members, right? But there are a lot of mom and pop shops in there, and there are the Cargills and the Unilevers and the Vodafones. So what we are focused on is on that group of 2,000 companies. Not because the rest doesn't matter, but we have to start somewhere as an organization, and we want to focus on those companies with that big impact. So if we need those keystone companies to move these systems in order to achieve the SDGs, we need to understand how they are impacting the world around them. And for that, we need measurement. And if you think about the impact management project and its partners as like a conveyor belt, that each of them are sort of putting pieces on it, we are sort of at the very end, and we pick the indicators that we think are best for measuring performance. And we do that according to these transformations in which we compare these industries. So to your question, is it fair to compare Shell to Unilever? No, it's not. At least not when it's about food systems or about energy. But it's definitely fair to compare Shell when it comes to, and Unilever when it comes to women in the boardroom, right? So it depends on the issue, and then it depends on the context. But what we do is we select them within the transformation. We look across, in this case, a food system, what are the critical players, and then we provide rankings for the entire system. So that's 300-400 companies, and sub-rankings per industry.
Can you get into smaller companies, though, developing countries too?
So what we do, we do correct for if you look at keystone features, this is not only size. So it also matters where in the value chain you are or in which geographic you are. However, our focus, our universe, has got very little to do with a lot of the companies that the classic impact investors are looking for, right? Because these are much smaller, up-and-coming companies. So. And I don't think it's fair, if to use your word, to benchmark those companies already very heavily, because many of these sort of startups are still looking for their place in the world. So you need to first understand what is the role of that company, what is it doing, before you can actually start to benchmark them and hold them to account.
Mm-hmm. Okay, well, we'll come back to some of these issues, but Elizabeth, I'd love to bring you in here now. So what role is the United Nations sort of playing in this, and sort of why is it important for an outfit like the UN to be involved, do you think?
Right, so thank you, it's nice to be here. So for those of you who don't know, UNDP is really the UN's global network. It's operating in 170 countries and territories, which is important ultimately as we think about adoption. And I was invited to join the organization April of 2018 by the administrator, and really his interest was in setting up a startup. How can we sort of respond to a lot of urgency with the Sustainable Development Goals? And UNDP, among the system, is really the custodian of the goals, operating across all sectors, across all goals, and in all the different countries and jurisdictions. So his interest was, how do we mobilize the private sector to really achieve these goals, and what can we do as an organization to drive more investment capital? And so the motivation was, how do we leverage, how do we mobilize? And the response was, we've been finding that if you talk to investors, we spent about 4 or 5 months really doing some careful interviewing, trying just to understand if these goals are so important, why is so little investment capital really flowing to achieve them? And so we had conversations across the board with different asset classes, with large companies and small companies. And what you find when you talk to business and finance leaders is that, without doubt, they see the Sustainable Development Goals as really their guidepost for what it means to be responsible or inclusive or sustainable. But what you also continually hear is they don't really know what it means to align capital with the goals. They don't understand how to do that in practice. And this was kind of a common occurrence that we heard across the board, no matter what type of investor, what type of company we were speaking to, the how. There are tremendous principles. We see great intentions on the market, and Clara and the Impact Management Project. So we launched SDG Impact at the General Assembly a year ago as a vision and a small team with some seed capital from the UN Development Program. And we quickly worked to partner with some capable and important partnerships, including with the Impact Management Project, because we knew we needed to drive this rather quickly. And what we found is that in the area of practice, we have what we kept hearing to respond to investor needs is that what can we do to sort of address the how? And so Clara and the network, as Herbrand said, it is like a conveyor belt. You have the organizations that have been very thoughtful about practice. So you have the IFC launched its new impact principles, and you have the PRI with its responsible principles, and you have the UNEP-FI, which has principles for banking, and you have the GIN, which come out with new characteristics. So you have all these high-level principles. But our job was really to look at that conveyor belt of organizations that are thoughtfully working in this space, and how can we introduce practice that would ultimately connect to what Herbrand has been working on so carefully in terms of benchmarking, and how in developing good practice for what it means to measure, to report, to disclose in accordance with the SDGs. If you're working on that practice, what does that mean in terms of integrity? And what the market was looking for is really some validation. In addition to putting into place some practice standards, which we've now released, we've done practice standards for private equity. And these, again, are 18 specific standards. They're assurance standards. They have a test so that each one you can understand if you're compliant, if you've met the standard, or if you're in the process of meeting that standard. Because the market ultimately has been looking for that accountability, that veracity, that some kind of integrity. And our job was really to reduce some of the barriers, the how, to fill that space and to drive that more integrity. So we have set up, we've released practice standards where private equity is out for public consultation. We're working hard right now to release standards for bonds that will come forward in November, and ultimately we'll be working on a set of practice standards to guide enterprises as well. And because there is this certification piece, we think that it sort of takes the seriousness of veracity, which again, we think the market is missing. There is no way to understand if your impact management practice is of sufficient quality today to be SDG enabling. And this is what we kept hearing. So I'll leave it there for now.
Okay. Well, actually, you mentioned the IFC impact investing principles, and I was actually at the sort of soft launch of that at the World Bank meetings in Bali last year.
Right.
And there was a question actually from Nick O'Donoghue from CDC, which I thought was very interesting, which was, is IFC really the best institution to be leading this effort? Who kind of gave it the legitimacy to do it? And could we ask the same here, should the United Nations be leading this effort, or should public-facing organizations be leading it, or should it be market-driven? And I don't know who, maybe to start with you, Gerbrand.
Well, that's really good. So there's always a question of legitimacy, and we get that question every time. So the World Benchmark Alliance is not legitimized to benchmark these companies, because who are we? So to fix that problem, because we believe you need an entity, you need to ensure that you have different stakeholders involved in your process. Mm-hmm. And these are, in our case, financial institutions themselves, companies, civil society, scientists, and government. Right? So there is not a single, I don't believe, although the UN in theory could do it, and it will on certain aspects, today's world doesn't have institutions that have the legitimacy and execution power to do all of this. So what you need to do is you need to create consortiums, and in a way the impact management project is doing the same, right? You can't just say this is how we measure and manage impact. You need to create alliances of people that come together and that together give legitimacy. So and that is very much needed, because if we want to go to a place where there's somewhat accountability on all of these standards and principles, we need to be able to put this stuff in the public domain, as well as the way that we value these things. So benchmarks in one way or another are just an accountability mechanism. You say you do this on the SDGs, but you compare to your peers, mm-hmm. tells a different story. And that's what investors and us as the general public need to know. So, but in order to do that, you ask the right question, which is about legitimacy. And my point would be that in today's world, there are not that many institutions that have that capability in and of itself. So every institution that is going to take this on, or a part of that system, needs to work with others to make it work. So what I find a worrying development that you can now sort of see, and it comes from all sorts of places. There's groups of investors that group together because they're not happy with the confusion. And then they come out with something else that's going to solve it, and the only thing it does, it creates more confusion, because it was only developed by investors. You have NGOs doing exactly the same thing, and then you have companies that will, they retreat in Davos on their mountain, and they come out with another set of principles, saying this is how we're going to solve it. And all of these things are fundamentally just causing more and more confusion. They all try to be the sort of the over, but this is not a place where you can just literally stand on top of a mountain and say this is how we're going to do it. You need to form circles with lots and lots of other people, which is tiring, it's difficult, but it's really the only way that, given today's sort of geographics and power balance, we can do this.
Okay. Last question from me before we open it to the audience, and I think this might be one for you, Clara. I guess it's about the quality of what we're measuring. You see a lot of annual reports boasting, oh, we created 50,000 jobs and we mobilized 500 million in additional finance, or access to energy, for example, but jobs for whom and doing what and where, and how are you kind of getting at that in your project? Or?
Yes, I think my opening point on context matters is trying to formalize what you've just said, so that it doesn't become, oh, what shall we include today?
Yeah.
But rather there is actually an accounting method that, as Herbrand has said, and I cannot echo that more strongly, what we are talking about here is a social construct. And I keep saying it's not physics. It's not like finding a truth that this is how to measure. It is something that we all buy into across disciplines. That is what is going to get us to consistency. And so if we know that, if we really know that, then we will recognize that you don't do this alone. You don't even do this within a small community like just investors. You do it together. And I think what we're seeing, to come back to your question, is the together agreeing on how to construct this practice of measurement so that it is giving us the quality that we need.
Yeah.
But I will end on saying, and I really hope there are practitioners in the room, I'm actually on secondment to run this project, and my background is as a partner at a private equity firm. And I can tell you I've done this in practice. I've also run a portfolio company in practice, and there are data gaps all over the place. So please don't think that we're up here preaching to you about how everyone should have perfect data and why don't we? We won't have. But where we are right now in the evolution of this is that we're starting to know where we don't have good data. We're starting to be able to have a conversation about the gaps with precision in a way that we haven't before, and that itself is a huge leap forward.
Okay. I just heard that Karima has been able to join us, so I think she's going to come on stage now.
And I think as she's getting settled, what we've been trying to do together and very much collectively is to introduce what are the practice standards that address, as Claire is saying, how do you set your strategic goals? How do you measure and manage? How do you introduce transparency and accountability? So it's a set of tight practice standards that have that certification framework attached to them that really speak to the how.
So Karima, thanks so much for joining us.
Thank you. Apologies to everyone.
I don't know how much you managed to catch in the wings, but it'd be so valuable to get an investor's perspective on some of these measurement challenges that we've been discussing.
Yeah, I mean, it's interesting to sort of be on the periphery, because as an investor, we've basically used a number of these, a number of the standards, and we've basically also been at it for about 10 years. And I think when we think about how this is working, it's been, so if we take the IMP, for example, I mean, when we look at the IMP, we basically see IMP as kind of giving us the language, the who, what, how much, contribution and risk. And so for a company like Leapfrog, which essentially started with a KPI of delivering impact via, serving the underserved. So we started with the who, and that language really helped. And we started with the who, and then it's essentially, we want to bring underserved emerging consumers products and services. And today, as we speak today, we're 10 years in, and we are, we're now in a position where we're now basically, we've invested $1.6 billion across 26 companies, and that IMP helps us to basically be able to speak a language that everyone is speaking, which is how do we bring, how do you, now that we know who, what is the impact? It's the underserved goods, and then the question is how many. We can say we're now reaching 150 million emerging consumers across the world today, but then the question is, okay, that's certainly scale, but how are we delivering? How are we delivering that? And how indeed is that impact changing their lives? And then the fourth being the contribution, which is what do we Leapfrog do, and how would it be that the impact would have been delivered, or what proportion of that impact would not have been delivered if we hadn't invested those dollars? And then finally is clearly where we basically are looking at the risk. So the language was there, and what the standards are also bringing, so the IFC standards, for example, is now that the language helps us to basically put our strategy together, and we put that together just to ensure that is now instilled into our investment process. And then at the end, we then get independent audit. So the key thing is that everything is additive. And now we have the UNDP standards, which clearly are really about SDG. The SDG goals, and exactly how different funds are able to are contributing towards that. So our perspective as investors is, one, ability to ensure that our portfolio companies understand the language and can deliver the impact And that involves data. And actually, in order to be able to analyze whether that is being delivered. And finally, also, we in turn have investors. And so when investors are making a decision about capital allocation, and social value is a big part of that, that they're able to speak with a language that everybody understands. And that they can, whether it's a fund like ours, which is really around one KPI of delivering to emerging consumers in across the world, or it's delivering education in an inner city in New York or London, that we're able to then be able to benchmark accordingly. And so where we are today is that there are several standards and new ones are coming in all the time, is that we just need to make sure that each one is additive and that they're adding to the whole, so that we can, so that we're not, so that we can continue to deliver in the right way, whether it's from the portfolio companies and reporting and data collection, to us being able to put it in a way in which total investors, whether they're grant givers or impact investors, can able to look at them in the same way. So one thing I would say is I think there's a need for principle and standard bearers to have a conversation together to ensure that each new one is indeed additive and it is kind of delivering in a way that, the sum of the parts is worth more, or I should say, so that the total is worth more than the sum of its parts, I should say.
Is there a sense that it can be quite burdensome then for your
I think it's
portfolio
getting there.
companies?
I think it is getting there. I think it's because there's some overlap. I do think when we look at what we've done to date, it's now the matter of benchmarking what we're seeing to date. It is getting that there are lots of different standards. And I think one of the reasons that is the case is because there is clearly a need. We've got a number of people now going into this area, but more importantly, I think Sir Ronnie Cohen spoke recently and just said, there will come a time when every dollar that we spend, even will basically have to justify its impact. And so that clearly has created a need for having a common language, and everybody's coming at it at the same time, which means for people like us who have to then implement, it's quite confusing and overwhelming. So I do think there is a need to take some time out right now and just to make sure this is where we've got to now, and that every other standard or principle is actually additive and that they work together, which is why I gave the example of how we work, how IMP, IFC, and then when we look at the UNDP standards, that's about the SDGs, but it's important that it's all one.
Yeah, absolutely. Do you have a sense, though, that Leapfrog, for example, could be really at the top of this game? Your impact really is impact. When you say job creation, you mean for people that really needed those jobs, and they're good quality jobs, and in the places where they're most needed, versus some other, maybe some competitors of yours who might be putting out the same data but without the veracity. Do you see that there is a sort of unequal playing field, or?
So it's, I think we started with who, right? Yeah. So I think, and then this is what but I do think it's a possibility to start with what, and so where, and so if there are other impact investors who might start with, what do we want to do, and as long as there is a gap that they're able, that they, I think they can exist as well as we do, but I do think there is a need for a benchmarking, because jobs, so 100 jobs in healthcare in Lagos today are not the same as 100 new jobs in London, where there's an NHS, and the NHS is under a lot of pressure, but in Nigeria there is a lack at every level of healthcare. So I do think there is a need for benchmarking that enables the grantors or investors to be able to then be able to basically allocate capital efficiently where they need it to go.
Okay, brilliant. Well, let's get some questions from the audience then. Gentlemen here, and maybe let's take two at once, maybe.
So I understand the point.
Could you introduce yourself?
Yes,
sorry,
I'm Sony Kapoor. I'm managing director of Redefine, and someone here made the point about us having been really bad in the past about measuring impact. That is correct. But do you fear that we might go overboard? That we might try and measure things that are fundamentally unmeasurable, attribute things that are fundamentally unattributable, and end in with a situation where, for example, 5 units of gender inclusion, 2 units of financial inclusion, 5 units of renewable energy, you can make yourself look good however you want, right? I mean, we're fundamentally trying to measure and quantify and put spurious accuracy on things that really are hugely uncertain. I mean, CDC having created the private equity market in India, for example, I mean, would it have registered in what we're trying to do today? And if you move your finger as a large investor, if you look at the Dutch pension funds, they're doing SDG investing. If you move your finger, you create a job somewhere, you pay a tax somewhere, and you generate energy, right? I mean, everybody has an impact, and everybody has a strong incentive to report it exactly as they want. My impact, what I'm interested in, what someone else is completely fundamentally different from what somebody else is trying to do.
Okay.
So the fear is it possible that we may be going overboard? That's the basic
Okay,
question.
and maybe take one more question. Lady in the front here.
Rebecca Jones from the Make My Money Matter campaign. Addressing that point, absolutely. And I think that, Gerbrand, you said earlier that we are in a situation where we need to listen to everybody that's working in this area. But there are lots of people working in this area, as everybody has said. And without a real firm benchmark to hold asset managers to account to hold investors to account to, we are going to struggle to give legitimacy to impact investing. I've been a sustainable journalist writing about this for a long time, and the objection is always the one that this gentleman has raised, which was, well, how can you possibly measure this sort of stuff? It's all very fluffy, so let's just stick to the old risk and return, ROI measures and forget about that. So we do need, the FCA or PR, PRO, whoever it is, to say these are the rules, guys, because otherwise, we're just always going to come up against the same objection, surely.
So I can take it.
Yeah.
Wasn't what my suggestion.
So I think and then I give it to you.
Sounds like we can all say something. Yeah.
So there's a popular phrase that every investment has impact, and some people draw the wrong conclusion for that therefore every investor is an impact investor. So it doesn't work like that. The point here is that I do think it matters that pension funds move their finger, right? Even if it's just a little bit and then take another step. I think we haven't scratched the surface of what you can actually measure. What we are starting to sort of reach a limit, in my perspective, is the attribution question. So there are too many people standing on a soapbox claiming attribution to a certain point. And it's helpful to wake up in the morning and think, what am I going to contribute to the world? That's a healthy attitude. But it's not so healthy to conclude every day by trying to define what your contribution has been in a place where we fundamentally all have to collaborate. It's that sort of attitude and trying to make those claims that I think is hindering a lot of the good stuff that should happen in collaboration. And to your point about, when I say everyone, I mean all the sector. We don't need everyone, right? We need to make sure that we have the right people around the table that have the voice and the credibility within their communities to provide credibility to whatever measurement and framework we come up with. And that certainly is not everyone. But it does mean, but once we do that, so in our case, we're now going to start developing a benchmark for financial institutions. These are for the larger ones, so it won't be the ones like Leapfrog, but it would be more the BlackRocks and whatever follows, the 300 that follow after. Because we need that sort of accountability on those big institutions. They're not impact investors. They've never started with who, but we do need. But because they move so much money, and because they have the disproportionate impact on their system, we need to start creating accountability on how they see impact around the world, on the world around them.
I'm just a comment on the question. I'm sorry that I'm going to say it depends, but can we just talk about risk for a moment, right? We used to just measure return in finance. And I feel like today it isn't, I think you just said it, or someone else said, oh no, you just said it, we just stop with risk and return. It's just completely accepted that we all will measure and disclose risk when talking to the ultimate asset owners of capital and when companies talk to their investors. That wasn't the case until even the 70s through to more recently. Risk is an incredibly complicated concept to get your head around. To be honest with you, I could absolutely imagine if this panel had happened 40 years ago, someone would have said, well, isn't risk too fluffy? Why would we bother measuring it? So I don't think that's an excuse anymore. It doesn't mean that I'm sitting up here saying that you should quantify everything. I think qualitative measurement has an incredibly important role to play, and we do a lot of work in that area. We do a lot of work on surveying as a technique to get qualitative feedback from people whose lives are changing about the significance of that change. So that, again, is not a criticism, right? People mustn't just assume it's going to become this terrifying, inhumane activity. Not at all. We have the tools. We can actually make it much more sophisticated than we have done if people can really embrace it and put their energy behind it the way that we have with risk analysis. So I hope that that's a positive message for you. And it doesn't mean that it will be perfect, though. But nor is depreciation of software and accounting.
So I'd just like to add to that in the sense that because we're clearly, having invested in 26 companies now, we've had that, we started out as a company that was just talking about how many emerging consumers we reach, and we do report that. But as depth became more important, and we started to do the analytics of the data we have, what we actually have found is that when you start to look at risk, the other side of that is clearly opportunity. So once you start to do the qualitative surveys, and you actually you ask consumers, how is this product helping you, or through the companies, or why aren't you taking up this insurance product? We've learned so much more, which is essentially that that if I can pay, we had a health insurance product where the cost was maybe $10 a year, and people said, well, I can't take that. But they said, but I can afford $1 a month. Everybody can do the math, but it's really about if you can basically design a product in which I can pay my premiums monthly or whenever the money comes, then all of a sudden I will take this product. And through those surveys, we've also found that, yes, I don't really want to put my money into life insurance, which I'm not going to touch it, which nobody will get until there's a death in the family, because I also want to educate families. So a number of those hybrid products where people are basically doing partial risk, and part of it you can cash out for the education of your children. So, and then clearly, so I do think that, and all of this hasn't cost a fortune. We've just done it in a way in which companies can embrace that. And so and as soon as you start to do that, some of the other things, I heard you say materiality earlier on, materiality, additionality, all of that starts to come through, because all of a sudden, you are able to basically deliver product design, distribution, in a way that the customer wants it, which essentially makes it sticky. So we actually see that when it comes to insurance, we're actually having retention rates. Every year people are because it's actually becoming relevant to them. So 10 years ago we would have said, surveys? And it would have been much more difficult. But the fact is that, I didn't have my mobile phone, but the fact that we've got a computer in our pockets, and that's enabling us to reach emerging consumers in a way that we never were able to 20 years ago, is actually meaning that we are able to continue to collect data and continue to manage and continue to kind of get the better outcome. So to the question you asked earlier on, will there come a time when we're just measuring stuff just for the point of it? When that day comes, our work is done. I'd be delighted, because 2/3 of the population in the countries that we invest in are underserved. The financial services are there, but the big institutions are saying, I can't serve them profitably, and it is possible to serve them profitably. So I think we've still got a long way to go.
I think that is probably a good note to end on, because we are now out of time. So I'd like everyone to thank the panel.